The big tech IPO is back. First ARM, now Instacart, and also Klaviyo, another venture-backed company. But these listings are looking very different than a few years ago. Deirdre Bosa has more for us in today's Tech Check. Deirdre?
Kelly, we're still early in this round of IPOs. There's only been ARM, but of course we are looking ahead to Instacart, which is, a well-known household name, and Klaviyo, which is an enterprise software company that has been popular with investors a few years ago. But as you said, we're in a very different time. One, the market's more fragile. We don't know how they're going to go this week. And this time around, it's been characterized by down rounds. That is when a company raises money at a lower valuation than their last round. So as we know, Instacart was valued at nearly $40 billion just a few years ago. It's going to go public around $10 billion. Klaviyo as well. It was valued at around, I think, $10 billion in its last funding round. It's going to go public around that, slightly less. So it maybe tells us that bankers are being conservative this time around. There's also the issue of scarcity. The floats in these IPOs are incredibly small relative to what we've seen over the last decade. Some numbers from Deal Logic. On average, companies have sold 16 to 29% of their shares in IPOs over the last decade. ARM, Klaviyo, and Instacart, they're all floating less than 10% of outstanding shares. So that's very different, and that could lead to some volatility on those first trading days. Part of that, too, Kelly, is they're looking for cornerstone investors. These are investors that agree or are given an allocation of shares at the IPO. Big names like we saw with ARM look for an Amazon or an NVIDIA. In the case of Instacart, it's looking to Norway's sovereign wealth fund, and that provides a little support and hopes to drum up some more retail enthusiasm. So it'll be interesting to see what happens, Kelly, but all of these factors, they're important for the sustainability of this window staying open.
For sure. I think it's much better for the kind of public to get in on the downside than on the upside. But what about employees, Deirdre? I mean, do we have any sense of whether they're still going to be well in the money at these levels? Are some of them, frustrated that they're going to get maybe a $9 billion instead of a $50 billion valuation or whatever for their company?
Absolutely. I mean, a lot of the employees, especially the earlier ones, they'll be okay. And, there's things they can do in the cap table and financial engineering to make sure that employees come out okay. They make some money from this, but it is complicated, and it's not as much as if they were looking at a $39 billion valuation. But Kelly, you and I have talked a lot about how down rounds could be good for the retail investor, but a word of caution here as well. The last time we saw sort of a valuation that, let's call it flat, that was Uber a few years ago in 2019. It was disappointing because it had raised so much money as a private company, and the IPO was sort of around that amount. It still didn't do well. So investors got to be careful. And there's some similarities between the two, right? They're both gig economy companies. We're seeing increasing competition at the point of their IPOs. Instacart is profitable. That's a key difference. But important to keep in mind that just because it's a down round IPO doesn't mean it's going to be a good investment.
Great point. Deirdre, thank you. We appreciate it today, and we'll see how it goes this week. Deirdre Bosa reporting.